Now let's bring in David Dietze, Managing Principal and Senior Portfolio Strategist at Peapack Private Wealth Management. Thanks for your time today, David. We got some good news on the economy, which turned to be bad news for stocks. But how vulnerable is the Fed's plan to trim its interest rate increases to the strong economic data that we're getting? Do you think they will shift back to inflation fighting mode?
Well, that's the big question here, and one of the reasons traders were selling stocks today. When they released the statement after the November meeting, they talked about being very sensitive to the fact that monetary policy acts with a lag. We got a lot of Fed speakers talking about the need to not overdo the rate hikes. Indeed, on Wednesday, Chair Powell also all but told us we were going to just get a 50 basis point hike in their meeting later this month, and not the 75, although he did caution that the terminal rate may be higher than many people believed, and the rate hiking cycle goes on longer. So, the question now is whether the last couple days of stronger than expected economic numbers, the jobs report on Friday was stronger than expected, today's service index stronger than expected, is that going to be enough to knock the Federal Reserve off of its slight dovishness here and renew their rate hikes? Well, we're not quite sure. A couple things I would say. One is, of course, the Fed is focused on inflation. They want a strong economy. They just don't want the strong economy with inflation. So by selling just based on better than expected jobs or better than expected service report, you have to make that leap of faith that extra strength in the economy is automatically going to translate into much worse than expected inflation. And there's some reasons to doubt that. Basically, the inflation metrics we've been seeing, including the most recent Purdue consumer expenditure number that came out last week, suggested that inflation was slowing. We've seen commodities turn over and so forth. So I think that the Fed is also very concerned about not producing a recession. So, I'm not sure that the Fed is ultimately going to all of a sudden turn much hawkish based on these two single reports.
Yeah, but so we saw that strong economic data. There are doubts about what the Fed will do next. But then we've got China reopening. Do you think it's time to add risk, or is it time to book profits?
That's a very broad question. I think it's a time to be selective. And of course, you really have to realize if you do book profits, where you're going to go. One of the big tailwinds, of course, to this market rally since October has been a dramatic reduction in interest rates. So, for example, the 10-year Treasury was at about 4.3%. It got all the way back to under 3.5. It did back up today. So, bond yields may not look all that attractive right now, other than in the very short end. Of course, people are looking overseas. That's everyone's kind of new favorite place, but they're not quite sure they have the confidence in the economic strength overseas. China, of course, as I've seen and explained to my clients, some of the Chinese internet stocks, based on some of the ETFs here that we track, are up about 62% since the middle of October. So the question is, are they too late to get on board there? Can they really trust the consistency of Chinese policies to indeed open up the economy? And even if they do open up the economy, will that result in all sorts of fatalities and sickness from COVID that will cause them to reverse policies? So it is very tricky here. But basically, we think investors should kind of stay the course. One thing you have going for you is there's a lot of pessimism right now. No matter what the numbers are, people say it's a negative. The economy looks strong. They say that's bad. The economy looks weak. They say we're going into a bad recession. So that often counsels people to stay the course because at least you have the negative sentiment to help support prices.
Really quickly, David, before we let you go, what happens to the dollar now that there is so much pessimism in the markets, but there is some increased risk as well?
Yeah, absolutely. So that's a great point. So one of the tailwinds for the rally since October has been the dollar retreating, and now it's back to levels we last saw in June. Is that dollar going to get back up and get strong again? Well, that, of course, depends a little bit on will foreign currencies fall. We're seeing, of course, some improved strength potentially in the Chinese economy if they really open up these economies. Certainly, the needs for energy in Europe haven't been quite as bad as increasingly thought. So we're getting just a little bit more optimistic on overseas economies, which might check any rise in the dollar. And of course, if the dollar rises, that tends to be kind of anti-inflationary here, which might give an additional reason for the Fed to be a little bit more cautious on their rate hiking campaign.
Well, we'll watch that closely, David. Thanks so much. David Dietze there, managing principal and senior portfolio strategist at Peapack Private Wealth Management.